Hello and welcome to this video presented by Acuna Capital. This is the third video in a series of payoff diagrams. You should have already watched call and call spread, as well as put and put spread videos before diving into this one. In this video, we'll discuss what a call fly strategy is, we'll do a step-by-step payoff example, we'll discuss why someone might want to trade a call fly, and then we'll discuss how a put fly compares. So let's start by answering the age-old question of what a call fly is and what the payoff diagram might look like for one. A call fly is a strategy made up of four options. You buy one contract of the first strike, sell two contracts of the middle strike, and buy one contract of the third strike. Most of the time these strikes are equidistant, meaning that the wings are an equal distance from the middle strike. If it's not the case that the strikes are equidistant, traders will specify that it's a non-symmetrical fly. So in this case, this is a 40-point wide fly, since it starts at 310 and ends at the 350 strike. So let's go through the payoff by adding the four strikes together from left to right using what we learned in our call spread video. I'll start with our axes, which are again P&L on the y-axis and strike space on the x-axis. I've drawn our zero line horizontally, which will help us distinguish between ending up positive or negative in P&L for each point on our plot. I'll add the three strikes that make up the fly on the bottom. And for our example, we'll plot the payoff diagram from the perspective of someone who's paid $7 for this call fly. I won't break down the individual option prices when adding the legs, and will instead go back and use this $7 total strategy price to calculate our max gain, loss, and break-even points. First, we'll plot the payoff diagram for our first leg, buying the 310 call. We'd use the price of this call as our intersection on the y-axis if we wanted to, and as we learned in our call video. Next, we'll plot the portion of the payoff diagram of selling two of the 330 calls. Notice I start above the 0 point by the price of the two calls, and the slope of the line once we cross 330 is 2 to 1, so for every dollar the underlying increases, we'd lose $2 from the sale of the 330 line options since we sold two of those calls. Now let's take these two payoffs and add those together first. The dotted line becomes our resulting vector. We'll now clean up the pieces from the first three initial option legs and plot our result. Now we simply plot our last leg, the purchase of one 350 call, on top of this. Again, we'd use the price of this option as our horizontal line, and we'd start making money once the underlying moved above the 350 strike. Once again, we'll add these two vectors together to get our final shape of the payoff diagram. This symmetrical pyramid, with its peak right in the middle strike, is our final payoff diagram for a call fly. Now let's start filling in our numbers. We'll begin with our max loss, which in this case is the cost of the fly. This occurs anywhere outside the further strikes of the fly, and in this example, our max loss is $7. So it's clear that the buyer of the fly wants the underlying to finish somewhere within the strikes of the fly. Now let's calculate our maximum gain for the buyer of this fly. It's pretty clear that this happens right at 330. And we can use the fact that we know a symmetrical fly can never be worth more than the difference between the middle strike and the first strike, in this case 20. If we know the price we paid for the fly, and the maximum amount that it can be worth, we can subtract these two numbers to arrive at our maximum gain, in this case $13. Finally, let's look at our break-even point, of which there are two in this example. The first we get by adding the price of the fly to the first strike. This makes it clear that the underlying must finish at least above 317 to recoup our $7 cost. Anything above that amount, up to our second break-even point, makes the buyer a profit. The second break-even point, therefore, is found by subtracting the price of the fly from the third strike to arrive at 343. So, any closing price between 317 and 343 at expiration is where the buyer of this fly would make a profit. Anything outside of that would result in a loss. Now remember, as we stated in earlier videos, these are payoffs at expiration and assuming that the buyer simply bought the fly for the price 7 and didn't hedge with the underlying at any point and just waited to see where the underlying finished at expiration. In our final video of the payoff series, we'll discuss why market makers don't usually think this way. Since they trade thousands of options and option strategies per day, they don't focus on one payoff diagram. Now let's quickly look at how the payoff diagram for the seller of this fly at a price of $7 might look. We can think about and construct the payoff strike by strike, or we can just reason that the payoff will be flipped around the 0 point since this is a zero-sum payoff between the two participants. Therefore, the maximum payoff occurs if the underlying has a higher volatility and moves away from the 330 strike, while the maximum loss of 13 occurs if the future pins the 330 strike. Pinning is a term to mean that the future finishes right at the 330 strike at expiration. Now let's step back and think about a few questions which are commonly asked at this point when learning about payoffs for call flies. The first is usually, why would anyone want to trade this fly? The first is that it has a fixed downside and a known upside payoff. This makes it easy to think about in cost-benefit terms compared to some other more complex strategies. It's also less cost than buying the 310-330 call spread, which gives you a similar risk profile if you think about the future finishing in this area. But the most common reason is that if you look at a payoff of this strategy, and if I overlay a few probability distributions above it, it becomes clear when I do this that this is a great way for someone to bet on a price distribution when they have a view on how the volatility is priced relative to their own belief on the distribution of the underlying at expiration. So the buyer of this call fly, in this case, might think that the volatility distribution is tighter and therefore the fly has a higher probability of finishing near the max payoff. If there's a higher volatility than the distribution, it's flatter and the fly may be overpriced at 7 and the seller might win to selling it at this price. Therefore, in either case, a fly is a great way to bet on the distribution of an underlying's price if you disagree with the market's option pricing of this strategy. So now let's look at what happens if instead of the call strikes, we trade the put strikes and buy the put fly instead. Well, it turns out that for payoff purposes, nothing changes. The price of the put fly is identical to the price of the call fly, as are the Greeks, the Vega, the Gamma, and the Theta. These are all the same, barring any special situations. Therefore, we can think of a put fly and a call fly as the same for payoff diagram purposes. So with this, you've worked through your first call fly payoff diagram. In the next video, we'll discuss straddles and strangles. Thanks for watching this video, and get in touch at akunacapital.com.